While everyone around you is panicking right now, this opportunity is quietly growing. And I mean that literally. Right now, as headlines scream recession, as portfolios bleed, as your colleagues in your group chats are filled with fear, a specific set of assets and positions are being set up for one of the most powerful runs we have seen in years. Most people are not prepared for this. They're too busy reacting to the noise to see what's actually building underneath it. Here's the uncomfortable truth. The investors who built generational wealth in 2009, in 2020, in every major panic cycle in history, they were not the ones who waited for the all-clear signal. They were the ones who understood what was happening while everyone else was frozen in fear. Today, I'm going to walk you through exactly what that opportunity is, why it's growing right now in 2026, and the specific moves you need to be making. Not next month, not when it's obvious, right now. Make sure you stay until the end, because the most important part of this video is the piece that 99% of investors are completely missing. Leave a like if you're watching. Let's get into it. Let's set the scene, because context is everything here. We're living through one of the most anxiety-driven market environments in recent memory. Tariff escalation, sticky inflation, a bond market that is behaving in ways that are genuinely unusual, geopolitical fragmentation accelerating faster than at any point since the Cold War, and a Federal Reserve that is stuck, not willing to cut aggressively because inflation hasn't fully surrendered, but fully aware that the economy is slowing under the weight of high rates. That combination creates fear, real, widespread, paralyzing fear. And here is what fear does to markets. It creates indiscriminate selling. Investors don't just sell the bad stuff, they sell everything. Good assets get thrown out alongside zombie companies that genuinely deserved to fall. This is not a theory. This is documented market behavior going back over 100 years. And it creates something incredibly valuable for the prepared investor. It creates mispricing. It creates a disconnection between the price of an asset and its actual underlying value. And historically, every single time, that gap closes. Sometimes violently, sometimes slowly, but it always closes. These kinds of macro shocks are a normal, recurring part of the cycle. Every generation experiences them. The question is never whether you'll face one. The question is whether you're positioned to be a victim of it or a beneficiary of it. Right now, you have a choice, and the window to make the right one is narrowing. Here's where it gets really interesting. This panic is different from 2008. It's different from 2020, and understanding that difference is the key to understanding the opportunity. In 2008, the panic was justified by a fundamental structural collapse. The banking system was genuinely broken, trillions in hidden leverage unwinding simultaneously. That was a real, deep, systemic crisis that required years of repair. In 2020, the panic was driven by a complete shutdown of the global economy, unprecedented, justified fear, real economic damage. What we're dealing with in 2026 is different. The fear is real, the uncertainty is real, but the underlying mechanism is not a collapse of the financial system. It is a repricing, a recalibration, a forced adjustment of expectations that built up over a decade of extraordinary monetary conditions. And here is the key insight that most people are not grasping right now. Repricing events, unlike structural collapse events, tend to overshoot massively on the downside, and then they snap back hard. Look at this chart right here. Every major tariff-driven or geopolitical shock-driven sell-off in the last 40 years, 1987, 1998, 2011, 2018, every single one overshot fair value on the downside. Every single one subsequently recovered, and the investors who bought into maximum fear, not at the exact bottom because nobody catches that, but into the period of maximum fear, consistently came out ahead over any 18 to 24-month window. That is not an opinion. That is the historical record. And right now, we're in maximum fear territory. The sentiment indicators are flashing it. The put-call ratio is screaming it. Fund manager cash levels, look at this data point, are at some of the highest levels since the 2008 lows. That is extreme defensiveness. And historically, extreme defensiveness from institutional investors has been one of the most reliable contrarian buy signals in market history. The scary part is, most people see this data and still can't bring themselves to act on it. And I'm going to explain exactly why.
Let's talk about your brain for a second, because this is crucial. There is a well-documented phenomenon in behavioral economics called loss aversion. And what it essentially means is that the pain of losing money feels roughly twice as as intense as the pleasure of gaining the same amount. Twice. Your brain is literally wired to feel losses more than gains. Now combine that with a panic environment. Red screens, scary headlines, your neighbor telling you he just sold everything. Your brain in that moment is not your friend. It is screaming at you to protect yourself, to get out, to wait for certainty. And here is the brutal irony. The moment certainty arrives, the moment the headlines turn positive, the moment it feels safe, the opportunity is already gone. The repricing has already happened. The smart money has already moved. This is not a critique of you personally. This is how human psychology works. This is how it has always worked. It's why the same pattern repeats every single cycle. Smart people, informed people, people who understood the theory still got caught in the trap. Because when it's real and it's live and it's your actual money on the line, the emotional pull is almost overwhelming. The investors who break this pattern are not the ones with higher IQs. They're the ones who have a prepared framework, a plan they built in advance, so that when the panic hits, they're executing a plan rather than reacting to emotion. That's what today's video is about giving you. And this is exactly where I want to pause for 1 second, because in our free community, linked below, we've put together a full framework for building that kind of prepared positioning, the specific triggers we watch for, the exact allocation approach we use in volatile environments like this one. If you're serious about not repeating the mistake of selling into fear, I'd strongly encourage you to check it out. The link is in the description. It's completely free. Now, let's talk about the actual opportunity itself, because this is the part you came for. The good news is, and I want you to hear this clearly, this environment is creating some of the most asymmetric setups we have seen since 2020. Let me walk you through exactly where we believe the opportunity is growing right now. Opportunity number 1, high-quality equities at panic prices. The indiscriminate selling I mentioned earlier has created something remarkable. Companies with strong balance sheets, real earnings, real free cash flow, and genuine competitive advantages are being sold alongside genuinely troubled businesses. The baby is being thrown out with the bathwater, and when the repricing reverses, and it will, quality is always what recovers fastest and strongest. If you have a watch list of companies you've always wanted to own but felt were too expensive, right now is when you pay attention to that list. Opportunity number 2, the international rotation that is absolutely about to go nuts. Here's something 99% of investors are completely missing. The dollar has been under structural pressure in 2026, and when the dollar weakens in a risk repricing environment, international assets, particularly in Europe and select emerging markets, can massively outperform U.S. assets. Look at this chart. The performance gap between European equities and U.S. equities over the last 18 months is at historically wide levels. That gap does not stay wide forever. Capital rotates, and right now, that rotation is in its early innings. Opportunity number 3, gold and real assets. The move has started, but is not finished. Gold's performance in 2026 is not an accident. It is a direct reflection of institutional money hedging against dollar uncertainty, fiscal instability, and geopolitical fragmentation. The key insight here is that most retail investors have completely missed the first leg of this move. They're still not positioned. That means the second leg, when institutional momentum builds, could be significantly larger. We believe the real asset trade has years of runway left. Opportunity number 4, short duration, high quality bonds. In environments like this, where rate cuts are coming, but inflation hasn't fully surrendered, short duration investment grade bonds offer something remarkable. Real yield, capital safety, and significant upside price potential when cuts eventually arrive. The risk-adjusted setup here is one of the most attractive in over a decade. Now, pulling this together into an actual portfolio framework is where most people get stuck. They understand the thesis, but don't know how to size it, sequence it, or build around their existing positions. We break all of that down step by step in our latest research report linked in the description. We believe this is one of the most important pieces of content we've put out. If you're serious about positioning yourself for what's coming, check it out now. Let me bring this home quickly. The panic you're seeing right now is real. The fear is real, but so is the opportunity, and it is growing every single day. That fear stays elevated and prices stay compressed. History is clear on this, unambiguously, repeatedly clear. The people who position into maximum fear come out ahead. The people who wait for certainty pay premium prices for assets they could have owned
owned at a discount. You now understand the mechanism, you understand the psychology trap, and you have a clear picture of where the opportunity is building. Before you leave, you're looking at the effect, not the cause. The previous video explains what triggered this entire move and why most people will get caught off guard. Watch that first, where this won't fully connect. Subscribe if you haven't already. We cover these macro setups every week. Leave a like if this gave you value, and drop a comment. Are you buying into this panic, or are you still on the sidelines? I genuinely want to know where you're at. The people who prepare in advance are the ones who come out richer and stronger. And now, so are you.